Greetings to everyone. A warm welcome to you all for today's management presentation from Rain Industries Limited. My name is Sarang Pani and I serve as General Manager of Corporate Reporting and Investor Relations at Rain Industries Limited. Earlier today, we have released our results for the quarter and half year ended June 30, 2024, and the same is also posted on our website. Shortly, we will guide you through the performance highlights of Rain Industries Limited for the second quarter of 2024. The speakers for today are Mr. Jagan Reddy Nellore, Vice Chairman of Rain Industries Limited, Mr. Gerard Srini, President of Rain Carbon Inc., and Mr. T. Srinivas Rao, Chief Financial Officer of Rain Industries Limited. Before we proceed, the management would like to note that during this management discussion, forward-looking statements may be discussed that include various subjects such as trends, targets, and strategic directions. These statements rely on our current projections and are subject to risks and uncertainties that could cause actual results to vary materially from those suggested by these forward-looking statements. There are certain risk factors that could lead to results differing significantly from our predictions. The discussion today contains certain non-GAAP financial measures. The related non-GAAP reconciliations are provided in the accompanying slides. Please turn to slide 3 at this time, where Mr. Jagan Reddy will offer insight into the key developments at the Rain Group during the second quarter of 2024. Thank you, and I now hand it over to Mr. Jagan.
Thank you, Sarang, and greetings to all. As we turn our attentions to slide 3, let us start with a focus on safety. At the end of second quarter, our carbon and advanced materials segments reported a year-to-date total recordable incident rate or TRIR of 0.22 as per OSHA guidelines. During the second quarter, these segments encountered only a single recordable incident involving a muzzle strain due to manual labor with one of our facilities. Such incidents are regrettably common, highlighting the risks associated with physical overexertion and the importance of our program to continuously retrain our colleagues on the importance of prioritizing their physical well-being. Consistent with our prior discussions, our dedication to safety is steadfast. Our safety programs are being continuously refined to meet the changing patterns observed in our operations and the wider industry. During the course of 2024, we are also pleased to announce that we are implementing OSHA reporting guidelines to our cement segment so that all three of Rain's segments will be able to report common global safety statistics very soon. Regarding financials, the second quarter concluded with an EBITDA of 4.9 billion rupees, marking progress towards more normalized levels of earnings, despite being below the average historical performance. The improvement was unexpected and due in part to customers accelerating certain shipments, particularly within our distillation sector, thus shifting sales from the third quarter into the second quarter. Initially, this suggested a possibility of increased demand and subsequent order growth for the remainder of the year. However, this does not seem to be the case. There has been no uptick in orders for the second half of the year. Essentially, the accelerated second quarter shipments have merely preponed revenue ahead of the third quarter. In line with the previous projections, we continue to expect gradual recovery towards normalized earnings, but do not foresee achieving this until the first quarter of 2025. In the second quarter, we saw welcome progress with the restoration of our margins in the carbon segment. We are now approaching the margin levels we have historically achieved for two of our primary carbon products, calcined petroleum coke or CPC and coal tar pitch or CTP, after a sustained period where margins were narrowed. This shift is encouraging and results from two main developments. Initially, the margin contraction that affected CPC and CTP has leveled out. Despite a phase of improved realizations throughout 2021 and 2022, a decline began in the second quarter of 2023, which presented substantial challenges to maintaining stable prices for our products. Prices have now largely equalized after persistently navigating through a pricing arbitrage exceeding $100 over several financial quarters. The second notable factor aiding in the stabilization of margins is related to the cost of our raw materials. We have succeeded in aligning our raw material expenses more closely with the selling prices of CPC and CTP, our major products in the carbon segment. Our most significant challenge going forward is increasing the volumes of our key carbon segments, products CPC and CTP. While this effort will require time, it underpins why we are projecting a timeline continuing into the first quarter of 2025 to regain our historical range of earnings within this business segment. Despite ongoing challenges with volumes in our carbon segment, we observed an EBITDA margin of approximately 12 to 14% in the second quarter, approaching our usual range, an enhancement from the first quarter's EBITDA margin range of 8 to 10%. The pricing in the CPC market within the carbon segment is undergoing continued downward pressure. However, we anticipate that any additional price declines will be offset by decreases in the cost of raw materials. We are also pleased to inform you that the regulatory authorities in India have allowed import of green petroleum coke or GPC in line with the order of the Honorable Commission for Air Quality Management or CAQM, which was passed under the directions of the Honorable Supreme Court of India for our Special Economic Zone unit in Visakhapatnam. This will enable us to increase production at our Special Economic Zone or SEZ unit to its full capacity by the end of calendar year 2024. However, we are still awaiting the permission of the regulatory authorities for import of CPC into our SEZ unit for blending in accordance with the import permission which was granted by CAQM in their order. Importantly, our sales volume of CPC in the second quarter of 2024 marked a substantial rise compared to both the preceding quarter and the same quarter of the previous year. Our efforts remain concentrated on further expanding our global sales volumes of CPC, which have already rebounded in India during the second quarter in line with our expectations. Global aluminum industry forecasts continue to be strong, with aluminum prices around the $2,500 level, supported by relatively low energy costs and anticipations of a robust worldwide economy throughout the rest of the year. Regarding our carbon segment's distillation operations, product prices reached a point of stability during this quarter, even as supply volume pressures escalated. Current trends in aluminum prices, coupled with the recent previously mentioned advantageous decisions in India, which favor improvements in our CPC capacity utilization there, are contributing to an increased market confidence in our vital carbon segment markets. As we progress into the latter half of 2024, our improved margin performance instills confidence in a projected resumption of normalized margin in the forthcoming quarters. This potential upswing contrasts with the past year and a half of waning global industrial activities. Our advanced materials segments has shown consecutive quarters of increased volumes and profitability, propelled by declining natural gas costs and surging demand, especially in our HHCR resins business based in Europe. We are exceptionally satisfied with these developments, which stem in part from shipping complications in the Red Sea. These disruptions have led many European customers to reconsider the long-term consistency and dependability of their historical supply chains rooted in Asia. Consequently, we are not only expanding our sales in Europe, but also broadening our customer base, our customer network. Globally, economic indicators remain largely positive until date. However, we have seen recent declines in certain aspects of the markets. In the United States, economic resilience persists despite recent inflationary pressures, reflecting continued reasonably better spending on goods and housing. Europe is seen a reduction in energy prices approaching those before the conflict in Ukraine, coupled with recovery indicators in the industrial sector. China recently conducted its central convention to set its economic directives for the next 5 years. It is premature for concrete conclusions, but it is expected that some fiscal stimulus measures were planned. We remain optimistic that Rain has the capability to navigate through difficulties in this segment and capitalize on new prospects. Regarding our cement segment, the industry in India has experienced modest growth of 2 to 3% this quarter due to a slowdown in construction activities during the general elections. Nonetheless, external reports forecast a 7 to 8% annual increase in cement volumes for the fiscal year 2024-2025, fueled by consistent demand from infrastructure and housing sectors. Post elections, the government's allocation of significant development funds for infrastructure, approval of more housing schemes, along with the industrial expansion throughout India, especially given the government's stability in Andhra Pradesh, which is keen on developing and constructing its state capital, should enhance cement demand in southern India. Recent industry analysis predicts that between 63 to 70 million tons of new production capacity will be added to the cement industry in India over the fiscal years 2024-25 and 25-26. About 30 to 35 million tons of which is anticipated in fiscal year 2024-25 itself. Capacity utilization is also projected to increase to 71% in fiscal 24-25, up from 70% in fiscal year 23-24, propelled by rising cement volumes. Considering these circumstances, we are hopeful about Rain's ability to manage any challenges ahead of our cement segment and leverage potential opportunities. Now I will hand over the presentation to Jerry, who will provide further updates on the industry and our business on slide 4. Jerry?
Thank you, Jagan. Hello, everyone. It's a pleasure to speak with you all again. Proceeding to slide 4, industry reports are predicting a favorable trend for aluminum's market performance, countering the previously observed decline in prices and customer demand. Projections indicate that the worldwide production of aluminum is expected to strengthen over the next 5 years, surpassing the total production of the last 5 years. As we look at slide 5, in terms of key commodity price improvements and their impact on our business for the second quarter of 2024, we noticed an increase, particularly in benzene prices. This rise benefited portions of our liquid businesses in our advanced materials segment and the other carbon products category of our carbon segment. Our carbon segment experienced a 20% surge in volume growth during the second quarter, although prices for that segment's calcined petroleum coke and coal tar pitch remained relatively stable or saw slight declines. In the CPC market, there was a rebound in both demand in India and the US, recovering from what we missed in the first quarter. Regarding CPC pricing, we observed a drop in raw material costs that aligned with declining CPC prices. Interestingly, this was the first occurrence since the peak of CPC prices. Moving to the distillation part of our carbon segment, CTP volumes stayed unchanged from the first quarter, while CTP prices witnessed a 6% decrease in the quarter as well, which followed a 10% decrease in the first quarter due to substantial resistance to pricing. Our coal tar raw material prices showed minor change during the same period. In other areas of our carbon products, specifically within our other carbon products category, we saw a marginal increase in both volumes and pricing when compared to the previous quarter. We're also happy to announce that our advanced materials segment maintained its strong EBITDA performance into the second quarter, making it now consecutive quarters of strong EBITDA performance, with volumes exceeding our expectations. Following an optimistic start in the first quarter, we continued to see an upward trajectory in both pricing and volumes in advanced materials. In the engineered products category of our advanced materials sector, The quantities of both carbores and also petroleum-derived petrores remained comparatively unchanged following a significant uptick in the first quarter, with prices also remaining steady. Within the chemical intermediates category of this segment, our BTX products experienced stable volumes with an uptick in prices, whereas the volumes for phthalic anhydride declined as prices rose. Turning our attention to the resins and downstream materials category within the advanced materials segment, there was minor change in both volume and price compared to the previous quarter. Although the disruptions in the Red Sea shipping routes adversely affected the volumes of products from our engineered products category, these same adverse events have conversely been advantageous for our resins and downstream materials category in Europe. The region has shown increased demand for our HHCR materials regarded as made in Europe. Clients in Europe and the Mediterranean are recognizing the dependability advantage of sourcing from Rain's local production of HHCR, especially following another supply chain issue affecting alternative supplies from Asia. On slide 6, which focuses on revenue distribution by end industry, you will see that the aluminum sector accounted for approximately 42% of our total consolidated revenues on an LTM basis as of June 2024. This marks a 6% decline from calendar year 2023, mainly due to diminished volumes in our carbon calcination business in the first quarter of this year. We anticipate a rebound in the usual range of 43-44 by the close of 2024. Our remaining revenue streams come from various industries, including the important construction and carbon black sectors. I'll now hand over the presentation to Srinivas, who will discuss Rain's consolidated financial performance on slide 7. Srinivas, the floor is yours.
Thank you, Jerry, and hello everyone. During the second quarter of 2024, Rain reported a consolidated net revenue of 40.56 billion rupees, making a 5.65 billion rupees reduction from 46.21 billion rupees during the same period in 2023. The downturn was primarily due to a 5.58 billion rupees revenue fall in our carbon segment and a 0.53 billion rupee drop in our cement segment, partially mitigated by a 0.46 billion rupees rise in our advanced material segment. Furthermore, Rain experienced a decrease in consolidated adjusted EBITDA by 1.85 billion rupees compared to the previous year, attributed to a 1.78 billion rupees reduction in the carbon segment, a 0.06 billion rupees reduction in the cement segment, and a 0.01 billion rupee decline in the advanced material segment. Moving to slide 8, we can see that for the quarter ending June 30th, 2024, our carbon segment reported revenue of 27.95 billion rupees, a decrease from 33.53 billion rupees during the same period in the previous year. This quarter's increase in sales volume, however, was mostly attributed to a rise in our CPC volumes. Customers from Asia and the Middle East restocked this quarter following a destocking period in the first quarter of 2024, and some shipments slated for the third quarter were brought forward into the current quarter. However, in the second quarter of 2024, there was a 24.1 reduction in average blended realization due to lower market prices across all geographical areas. Currency fluctuations saw the euro appreciated by 0.4% and the US dollar by 1.5%, both against the Indian rupee. Consequently, revenues from the carbon segment saw a 16.6% year-over-year decline in the second quarter of 2024 for the reasons mentioned. The adjusted EBITDA for the carbon segment fell by 1,779 million rupees compared to the second quarter of the previous calendar year. The primary causes were delays in adjusting raw material costs to align with the drop in finished good prices. This impact was partially mitigated by higher volumes and strengthening of both the US dollar and the euro against the Indian rupee. Moving to slide 9, we can see the advanced material segment's performance. During the quarter ending June 30th, 2024, our advanced material segment earned revenues totaling 9.4 billion rupees, which is an increase from 8.94 billion rupees generated during the same period last year. The uptick in our BTS sales stuck to the expected quarterly patterns, with additional boost in this segment coming from elevated HHCR sales volume. These were due to the previously mentioned supply chain interruptions of many European and Mediterranean customers in their historical Asian supplies caused by the Red Sea crisis. Our consistent and reliable HHCR production volumes in our European plant underpinned and supported the increased sales demand from customers for our HHCR materials. In the second quarter of 2024, despite a 16.1% drop in the average selling prices, revenue growth in this segment was partially mitigated by the euro appreciating against the Indian rupee by approximately 0.4%. Consequently, revenues for the advanced materials sector saw an approximate rise of 5.2% in the second quarter of 2024 in comparison to the same quarter in the previous year. Adjusted EBITDA fell by 9 million rupees in contrast to the second quarter of 2023, as lower average selling prices were somewhat compensated by higher volume sales and in strengthening of the euro relative to the Indian rupees. Moving to slide 10, we can look at our cement segment, which experienced a 14.3% decline in revenue in the second quarter of 2024 compared to the same period in 2023, attributable to a 8% fall in realizations and a 6.8% reduction in volumes. The adjusted EBITDA for our cement segment saw a downturn of 59 million rupees as lower realizations were compounded by rising operating expenses. Moving on the next slide on debt. The second quarter concluded with a gross debt of 970 million US dollars, which includes working capital debt of 117 million dollars. The net debt stood at $747 million and with an LTM EBITDA of $177 million, our net debt to EBITDA ratio was 4.2x. For the next few quarters, as performance improves and debt are paid down, we anticipate this leverage ratio to gradually approach 3.0x. During the span of past 6 months, our euro-denominated term loan saw a reduction by 48 million US dollar, driven by $35 million in repayments and the remaining $13 million ascribed to the foreign exchange impact due to US dollar euro fluctuations. In terms of liquidity, we closed the quarter with $432 million comprised of a $206 million US dollar cash balance and $226 million US dollar available in undrawn credit facilities. The group allocated roughly $35 million for maintenance capital expenditure and plant turnarounds in the first quarter of 2024. I will now pass over the presentation to Mr. Jagan for his concluding remarks.
Thank you, Srinivas. Reflecting on the first half of 2024, we have observed sustained margin pressures in our carbon segment continuing from 2023. Nonetheless, signs of recovery emerged within this quarter. We predict that margin pressures will diminish in the latter half of the year, and we foresee margins normalizing in the first half of 2025. Our management team is also strategically working towards boosting our CPC volumes in the second half of 2024 due to the Honorable Commission for Air Quality Management order having raised the total green petroleum coke raw material import quota into India from 1.4 million tons per annum to 1.9 million tons per annum. This is encouraging, especially given that our domestic tariff area plant in India is already back to operating at full capacity. Additionally, with recent approval for RAIN to import green petroleum coke to our SEZ unit in India during the current quarter, we expect increased capacity utilization rates there by the end of 2024. We are currently awaiting permission to import CPC at our SEZ facility as stipulated by the Honorable CAQM's order, which will then further enhance operations at our global calcining plants and expand our market presence in Asia and the Middle East. Regarding our advanced materials segment, the stable margins noted over the past 2 quarters signal a continuation of this trend in the subsequent quarters. And regarding our cement segment, as previously stated in our opening remarks, we expect a rise in demand over the next few quarters due to Indian government's increased emphasis on infrastructure spending and decreasing operational expenses, which should aid in margin enhancement. As iterated in our previous quarter's call, while market conditions are beyond our control, cost management remains within our purview. We have begun putting into place significant cost reduction strategies across all regions with the anticipation of realizing their positive impact in subsequent quarters. One example of these savings can be seen in the adjustments to our EBITDA in our earnings report, which includes provisions for severance costs in Germany. To conclude, my heartfelt thanks to go out to our committed employees for their exceptional efforts during these trying times. Their dedication and tenacity are crucial for steering our company through this period of adversity. Although the past year has been fraught with obstacles, our resolution towards RAIN's long-term prosperity has not wavered. We are optimistic that our strategic measures will forge a path towards a fortified and resilient establishment. We appreciate your ongoing support for Rain Industries Limited and eagerly anticipate sharing further updates in the upcoming quarterly presentation. Thank you very much.